Hello everyone, it is my distinct pleasure to welcome you to FM19 Financial Markets. Before we get started, let's set our expectations. FM19 is your gateway to the exciting world of finance. For those of you who are taking accountancy and management accounting, this paves the way to another view of what your future clients, and of course you, will be dealing with. There will be a lot of technical concepts, so we'll come out of this course sounding sophisticated and refined. Something to look forward to, right? Terms and how they will be used are very important in finance. So as we go along the entire duration of this course, we shall endeavor not just to define the terms, but to correctly use them as well. So let's get started. Do you know that financial markets is a subset of financial economics? Financial economics is defined as a branch of economics that analyzes the use and distribution of resources in markets in which decisions are made under uncertainty. There are some key terms to pick up from this definition: resources, decisions, uncertainty. Whenever we talk about economics, we are always concerned about resources that are scarce, kulang, dili enough. And because they are scarce, they have to be managed and decided on intelligently because of the uncertainties that come along with decision making. Now back to financial economics. It is impossible to talk about financial economics without talking about the financial system. A financial system is a set of institutions such as banks, insurance companies, and stock exchanges that permit the exchange of funds. Others would define it as a system of complex and closely linked institutions, agents, markets, and others, which enables the transfer of money between investors and borrowers. And this financial system is comprised of the following: money, financial instruments, financial markets, financial institutions, and financial services. And our FM19 class is situated right smack in the middle of these components. To ensure a smooth flow of our future discussions, let us first know financial instruments. And let us do that by reflecting on the many definitions of financial instruments. Take a look. Financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. A financial instrument is a monetary contract between parties that can be created, traded, or modified. A financial instrument is a monetary contract between two parties which can be traded and settled. These definitions should tug at the heartstrings and bring that feeling of nostalgia because it must remind you of the basic accounting equation: assets equal liabilities plus equity. A financial instrument, then, is something that generates a resource, or an asset, by issuing either debt securities, representing liability, or equity securities that represent ownership. But perhaps one of the most exciting things about the definition given is the word trade, or traded. Can you guess what trading means in finance? Buy and sell. In finance, we don't just say buy and sell financial instruments. Rather, we say trade financial instruments. So, financial instruments are what are traded in the financial system. Financial instruments represent either a financial claim against an entity's assets. For example, imagine you are a bondholder. That means you have a financial claim to the assets of the entity when you demand for repayment. Or a claim against the entity's future earnings, such as when you are a shareholder who has the right to receive profit sharing, aka dividends. Needless to say, bonds and shares of stocks are examples of financial instruments. Next, let's talk about financial markets. Well, if we go straight to the heart of its definition, a financial market is simply where financial instruments are traded. Textbook definition would say it's a market in which securities such as stocks and bonds can be purchased or sold. It's a vibrant avenue where buyers and sellers meet. It's so alive and abuzz with energy that there are many different types of financial markets, and we shall get to know them in one of our future discussions. There are at least two participants in a financial market. They are called surplus units, or the investors, and deficit units. Who are the surplus units? Surplus units are those who have extra to give. Think of these as those people or institutions who receive more than they spend, and thus have extra funds to lend to others. They are also called savers or investors. The second participant is a deficit unit. Who is a deficit unit? Deficit units are those people or institutions who have spent more than they have received. In other words, deficit units go into a financial market looking for funds. That's why they are called users or borrowers. Now, what purpose do financial markets serve? Let's look at 2. Financial markets accommodate corporate finance needs. Corporate finance, or financial management, involves high-level decisions such as how much funding they need to get and what combination of debt and equity securities need to be issued in order to obtain such funding. Financial markets accommodate investment needs. Financial markets accommodate the surplus units who want to make sure that their excess funds are put to good use by investing in either debt or equity securities. Whereas deficit units talk about financial management, surplus units talk about investment management, which involves decisions on how funds will be invested. In short, financial markets provide the avenue for financial management decisions of deficit units and investment management decisions of surplus units. To complete our overview, we have what we call financial institutions. Financial institutions, sometimes called financial intermediaries, transfer the funds or financial resources from the savers to the borrowers. Remember surplus units and deficit units? As a review, I'm going to give a few examples and try to guess if they're surplus units or deficit units. Let's say a business looking for a loan. Of course, it's a deficit unit because the business is in need of funds. How about an angel investor? Well, an angel investor is a surplus unit. The giveaway, the word investor. How about a newlywed looking for funds to buy a new house? Deficit unit, definitely. What a potential shareholder? Surplus unit. How about the government? Well, deficit unit. In fact, the government is normally the biggest borrower. So imagine this. Those who have extra funds meet with those who need funds. Where do they meet? In the financial market. Who helps transfer funds from those who have extra to those who are in need? The financial intermediaries. Correct. So think about it. If you're a business entity that needs a loan, where do you go to? Most likely the bank, right? The bank is an example of a financial institution or a financial intermediary. Well, that's it for this overview. Just remember, financial instruments, financial markets, and financial institutions. See you in our next discussion. Ta-ta!